Really, the main thing that has changed since the pandemic happened last year is a change in underwriting. So loan to values, loan to costs have come down. Lenders are not being as aggressive with the amount of money that they want to put out. So last year on multifamily, we were seeing 75 to 80% loan to values. We're probably seeing closer to 70 to 75% for those same loans this year.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello, and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom, along with Steven Silverman. Steven, every day gets a little better.
Well, it's been interesting times, but we're moving out of everything we've been through, and it'll still take a little time, but there's a lot of things to think about in the market right now.
Well, there's a path that we can clearly see now, and it's certainly seeing it reflected in the stock market and the real estate market and everything else. You know, it's been interesting. I'm working on a number of projects, some development deals, and we're working on, doing some acquisition too. And it's been interesting in kind of dealing with the debt markets. And I just thought it would be a really good time to try to get a 30,000-foot view of what's going on from one of our old friends to tell us what's happening with the debt market, because it's confusing right now. There's a lot of changes.
We're commercial brokers. We're out in the market every day, and we have our clients looking for some properties that they want to acquire. Others want to dispose, and some of them running into problems with lending. And where do you go, and what's going on in the market? So let's address that issue.
Yeah, no doubt. I mean, it's been a situation where, for example, working on an industrial deal right now, a ground-up deal, and there's a line of lenders being very aggressive about wanting to loan on it. And then on the flip side, I've got an office complex that nobody seems to really want to touch. So it's a very bifurcated. They would have done that deal this time last year, but now it's different. Things are different. So let's listen to, it's a repeat guest. Actually, we've had him before, and we're excited to get it caught up with him, what he's working on. But first, Steven, I wanted to just take a moment to read a review. And as you know, I'm always welcoming of negative reviews as long as it involves you.
It's about you, yeah.
That's right. The positive stuff we like to read. It's important.
It's about you, yeah. I understand.
Yeah. But this is a positive one, and it says entertaining, insightful, and actionable. Whether you're established as an investor or just getting started carving out a profitable niche that's ready to grow, this is a must-listen podcast for you. Eric and Steven do an incredible job leading conversations that cover a huge breadth of topics related to the ins and outs of building a thriving real estate portfolio while effectively navigating the market with leaders who've actually experienced success themselves. Highly recommend listening and subscribing. That's from Josh Christ. Josh, very, very nice.
Thank you, Josh. And we didn't even pay you for that. But what Josh just said...
And the last name's not Silverman.
That's right.
Or Silver.
but what Josh just said helps us a lot, because when we get reviews, that's what the guests that we interview look before they decide to be a guest on the show. And to get the great guests, those reviews help us. So please post reviews wherever you can and just help us all stay together as a community and keep together doing the podcasts.
No doubt. Our producers work hard on trying to get guests for us, and it's not easy. I mean, a lot of folks want to know that when they're coming on the show and spending time with us, that it's worthwhile to them. And believe it or not everybody that does commercial real estate in the state of Florida investment knows us, Steve. And so there's a sales job that has to be done when we're talking to potential guests for the show. Steven, anything else before we get rolling with our guest?
No, let's roll into it. Today we have with us Casey Siggins. Casey specializes in the origination and placement of debt and equity financing for all commercial real estate product types. Casey and his team have closed nearly $1 billion worth of debt and equity transactions, and he is the co-head of Franklin Street's Capital Advisory vertical. Casey focuses on assets throughout the state of Florida, but has taken assignments throughout the country. In addition to taking on assignments in the core product types, multifamily, retail, office, industrial, and lodging, he has also worked on storage, land, student housing, healthcare, cannabis, and specialty use product types as well. Casey's team takes a data-driven approach to each assignment and ultimately endeavor to come up with a tailored debt and equity solution that fits their clients' needs in a timely and efficient manner. Casey, welcome to the Invest Florida show.
Thank you, Stephen. Thank you, Eric. It's definitely a pleasure to be back on the show with you guys. I really enjoyed myself the first go around, and excited to be back on the show. I think there's a lot to cover right now, and I'll try my best to keep it short and sweet and to the point. But looking forward to the conversation with you guys.
No, we really appreciate your time and coming back to us, imparting your wisdom on us. It's been an interesting year, 2020, and we're in 2021 and starting to get some clearing of the situation with the COVID. And why don't you talk to us a little bit about what that's doing with underwriting standards right now, Casey, and sort of give us a 30,000 foot view of what the market's looking like right now as we're starting to enter the final stages of this COVID nightmare we've been in.
Yeah, absolutely. So it's obviously been a very interesting year for everyone. It's mid-February now, so we're coming up on right about a year since the country really changed forever due to the COVID-19 pandemic. In terms of commercial real estate finance, the industry has been affected just like every other industry, and the financing side is no different. Really, the main thing that has changed since the pandemic happened last year is a change in underwriting, right? So loan to values, loan to cost have come down. Lenders are not being as aggressive with the amount of money that they want to put out. So, last year on multifamily, we were seeing 75 to 80% loan to values. We're probably seeing closer to 70 to 75% for those same loans this year. When you get into the commercial side, your office, industrial, retail, you're seeing deals that have, call it 65 to 70% leverage that we're getting 70 to 75% last year. So loan to value, loan to cost, they're down. Debt service coverage ratios, debt yields, they're both up, which makes sense when you look at the reduced loan to values. But debt service coverage ratios, typically 1.25. We've seen a lot of lenders shift and move towards a 1.3 or 1.35. Or even higher requirement to get a loan done. Lenders just really want more cushion in the property's cash flow, right now as there's all this uncertainty in the market.
Sure.
Sponsorship requirements have also seen a kind of a shift to the more conservative side. Personal guarantees on almost all bank deals are required these days. We're not seeing a whole lot of non-recourse debt get done unless it's very low leverage. But there's really been an exaggerated emphasis put on sponsorship track records and balance sheets. Banks, lenders of all kinds, really, they want to see a sponsor that has a proven track record with this specific product type, and they want to see a balance sheet that can provide comfort to their credit committees, high net worth individuals or individuals with, at least 1.5 to 2 times the loan amount. Liquidity is very important to banks right now. Having the liquid assets available should the property incur some kind of distress or things not go according to plan, and a sponsor who has that ability to kind of meet their debt requirements should the property not be able to do so. And then we've also seen an increase in reserve requirements, specifically on the securitized products. Fannie Mae and Freddie Mac right now, they're requiring on the conventional side 12 months of principal and interest reserves be escrowed at closing. And on the small balance side, 18 months of principal and interest reserves. So these are all new things that have kind of come out in the last 12 months.
So it sounds like that's a pretty big boost for the capital requirements, the reserve requirements. What was it before, Casey?
Yeah, so before, lenders were requiring replacement reserves, right? And they still require those reserves. But now, in addition to replacement reserves, lenders are requiring what they're calling a COVID-19 reserve, which, like I said, is 12 to 18 months of principal and interest, and it really changes the economics of the deal. In some cases, those reserves can be $500,000, $1 million plus, and that money's going into escrow from the loan proceeds at closing. So that just results in additional cash equity that investors need to bring to the table. It drastically changes the economics on some of these acquisitions for investors.
So, Casey, I'd like to ask you a little bit about distress in the market and what's going on. This whole COVID experience was so interesting because in every other major dislocation to the market, when it's a recession, everything goes into stress. And here we're seeing some asset classes actually got tremendous demand and other asset classes are really suffering. Can you just give us an overview of distress in the market?
Yeah, absolutely. So, obviously there are some pain points in the market right now. Specific asset types, hotels, retail, they're feeling those pain points a little bit more than the asset types that have been a little bit more, immune to the effects of COVID-19 and the overall economic results of the pandemic. So, right now in Florida, we're seeing pretty high delinquency rates on retail and hospitality. On retail, we're looking at about 11.5% delinquency rate, which means you're at least 30 days past or 30 days late on your payment. And on hospitality, we're seeing just about 9% of delinquent loans. So, that doesn't sound like a super high percentage, but when you look at the actual numbers, that's $1.2 billion worth of loans on the retail side alone that are now in some form of delinquency. It's almost $1 billion worth of hotel loans that are in some form of delinquency. So there's going to be a trickle down effect when lenders start seeing this amount of delinquency in the market, and it's drastically restricting the appetite that lenders have to lend on retail and hospitality assets. If they are lending on those assets, they're much more conservative loans, lower loan to values, higher debt yields, higher debt service coverage requirements. So, the distress in the market is truly having a real effect. And on the flip side, you've got your multifamily, you've got your industrial, very, very little delinquency or distress in those asset types. Right now, in Florida, we're seeing about a half a percentage of multifamily properties that are delinquent on their loans. In industrial, it's almost zero. It's 0.04%. So, industrial, multifamily, those two product types seem to be basically back to normal for pre-COVID levels of underwriting in most cases. So it's really kind of a tale of two halves, if you will, between the different product types. So that's what we're seeing right now. The
old story, being in the right place at the right time. And exactly. So with lenders being reluctant to lend on the hotel and retail, it just exacerbates the distress further because they can't dispose of their assets.
Exactly. Yes, it really is. There's a lot of people out there with retail assets or with hotel assets that are struggling to refinance or to sell their assets because buyers simply don't have access to debt capital to purchase these assets. So it's absolutely exasperating the problem. And, we're starting to see a little bit of positive momentum on the retail side. Not as much on the hotel side, but we're starting to see, inklings of lenders coming back to the market for hotels. So hopefully that positive momentum continues, and fingers crossed, because I know there's a lot of people out there that have assets that need some help from a financing perspective.
So just a quick question on one asset that if you speak to two people, you get three different opinions, and that's the office market.
Yep. Yeah. So office it's kind of right there in the middle, right? So, some people, some lenders still love office and believe that, all this talk about, office is never going to be the same and people aren't going to come back to work. Some people think that's nonsense. Other people truly believe in that and think that the traditional office has changed forever. So, in terms of distress, the office market in Florida has not seen a ton of distress. Right now, we're just under 4% in delinquent loans, which is not a terrible number. That's actually a little bit higher than the national average. But there's a few bigger properties in Florida, specifically South Florida, that are raising that number up. But office has remained mostly healthy. But there's still kind of a, touch and go feel to new debt and new equity being put out for office properties.
Talk to us a little bit about retail, because we manage quite a few retail properties and not really seeing much distress there at all. Now, granted, most of them are sort of those more neighborhood centers and grocery anchored types of deals. So where are you guys seeing the subclass? Is that something you can talk about, Casey?
Yeah. So on the retail side, I think a lot of the distress is in the bigger properties, your regional malls,
sure. Covered malls, yeah.
The indoor regional malls that, were shut down, and quite frankly, those type of properties were in a lot of cases already struggling pre-pandemic. So
yep.
The pandemic's just exacerbated the problem. In addition to that, you see all the headlines on the retail side, right? The big box retail is going away. We're seeing such a shift to e-commerce. The pandemic hasn't helped that. So there's a lot of properties out there that, had, a Sears anchor or, name any anchor that's gone out of business in the last couple of years. And those properties are struggling to meet their debt requirements. So that's where you're seeing the distress. But on the flip side, like you said, there's a lot of retail properties out there that have not experienced the same kind of pain points as those properties. So retail is kind of hit or miss as well.
Yeah, I mean, the way we look at it often is it's the retail that has the service component in it that seems to have a buffer against everything. It's the ones that carry the big inventory that suffered the most.
Right.
Except for alcohol.
Yep.
Anybody who's got an alcohol liquor store, their center's actually flourishing.
Those have done well, especially throughout the pandemic. But yeah, no, that's a good point. The retail centers that are doing really well are the ones that have, landlords and leasing teams that are getting creative. We're seeing a lot of medical office start to come into retail centers, doctors' offices, dentist office, physical therapy facilities. So, that's really helped a lot of retail centers is kind of shifting away from your traditional, brick and mortar, shopping type of retail and into more, creative type uses for that space.
Why don't we talk a little bit about the various types of lenders, because you've talked to us about banks and CMBS and life insurance companies, sort of generally speaking. Can you kind of drill down a little bit on each one of these types of lenders, the largest types of lenders, and what they're doing, maybe how they've changed over the last year?
Yeah, absolutely. And I'll run through them really quickly. There's about 5 or 6 main ones to touch on. But, we'll start with Fannie and Freddie. They've remained the most normal throughout the pandemic. There was a blip back last April, call it to June, where things were really touch and go with Fannie Mae, Freddie Mac, Ginnie Mae, HUD. But since last summer, things have really felt back to normal pre-pandemic levels. They're doing a ton of business now. We did see last year that Fannie and Freddie put out a $70 billion cap for, each Fannie Mae and Freddie Mac. That's a pretty significant decrease from where they were last year. They both had an $80 billion cap. And this year, there's a lot more emphasis on lending to properties with an affordable component. We have seen Fannie, and Freddie both have caps before that they've hit, call it halfway through the year, 3/4 of the way through the year. And, the those caps have been extended or, they've risen the caps. But, this year, I think they're going to stick to it so that there's going to be less liquidity in the multifamily debt market through Fannie and Freddie is my prediction. Moving on to CMBS. So the CMBS market is back in some ways and completely shut off still in other ways. So, for the preferred asset types that I touched on before, multifamily, industrial, some office, some retail, CMBS is lending again. Now, loan to values are down and they want to see higher debt yields, but, they are willing to make loans and we're seeing loans close. Hotels, certain retail, certain office, they're not touching. So it's CMBS is really kind of touch and go right now. Some life companies have come back to the market and are lending. Others are really still sitting on the sidelines until they see a little bit more proof that the economic recovery is happening. So life companies are kind of hard to put all under one umbrella. But, life companies have traditionally been the more conservative lenders anyway. And when you add, all the uncertainty that's in the market right now into the equation, life companies are going to be the most conservative if they're lending, at all right now. Moving on to the banks. Banks it's another group that's kind of hard to fit all under one umbrella, but we're seeing good activity from the community banks and the regional banks. They're really back to the market in a lot of ways. I think the thing is these community banks they're assessing their, local markets. They're looking for relationship type borrowers who aren't just going to do, one transaction and move on, and they're willing to lend. So that's been very encouraging. We're doing quite a bit of community and regional bank business. And then the last one I would like to touch on is the private debt funds, private equity debt funds that are traditionally used for your transitional assets, your major rehabilitation projects. They are mostly back to the market, I would say. They're not being quite as speculative and aggressive as they were pre-pandemic yet, but we're starting to see a lot more activity in that space. There's a lot of groups out there competing for that bridge loan market. So it really kind of depends on where you're at in the country and what kind of property you're looking to borrow on and what your business plan is. Going back to sponsorship, do you have a track record? Do you have a balance sheet? Will you provide a personal guarantee? But the private debt funds are back at the table and lending again. So that's been very encouraging.
So talking about the guarantees, non-recourse loans, have they gone the way of dinosaurs?
No, non-recourse loans are still very much around. All Fannie Mae and Freddie Mac loans are non-recourse. All CMBS loans are non-recourse. A good majority of private debt fund, bridge loans are non-recourse, but really where you're not seeing any non-recourse loans anymore is banks. Banks had started dabbling in the non-recourse space pre-pandemic. It's still out there for very low leverage loans from the banks, but for the most part, non-recourse is available, but only from certain lenders that always do non-recourse regardless.
Why don't we talk a little bit about the equity? You guys still work in some equity too. So why don't you talk to us a little bit about what's going on in the equity markets?
Yeah, so the equity space is very interesting. Like everything, there was a pause back in last spring into early summer for most equity providers. But a lot of equity providers have started to see significant opportunity in the market to deploy capital. A lot of equity providers have raised a good amount of capital. They need to get it out the door, or they're going to have to give it back, right? So there's a lot of equity out there right now looking for opportunities to invest. Right now, obviously the preferred asset types, again, are multifamily, industrial, select office, select retail. There are, kind of opportunistic equity funds popping up to invest in distressed hotel assets. But, in terms of joint ventures, co-GPs, that type of equity is out there. So we have several equity assignments in our pipeline right now. We're seeing good activity, good feedback from equity providers, and the returns being required are back to about where you would expect, right? So most groups at the moment are looking for, I would say a minimum 12% IRR, but most likely, 14, 15% IRR and, a nice equity multiple. So, that the equity market's healthy. There's also, I would almost argue that there's more equity, out there looking to be placed than there are, opportunities to invest available. So it's just about finding the right, the right strategic partner that fits, that fits your investment horizon, and you have the same vision and strategy for the property. So that's the challenging part, but that's kind of where we come in. We help investors find the right partners to come in and get involved in the deal.
So let's talk a little bit about some of the niche markets. We spoke about multifamily and retail and industrial, the core assets, but there are other little segments that investors are focusing on. Can you talk a little bit about those and which ones are looking good?
Yeah, sure. So storage has been very active throughout the pandemic. My partner and I working on several storage deals right now. Storage is one where, there's a lot of conversion and kind of redevelopment into storage going on. Cold storage is becoming very popular. Cold storage is, obviously huge for a variety of reasons, but we're seeing some of that right now. The cannabis space is very interesting right now. We have a couple different cannabis transactions in our pipeline, and we've actually found bank debt for cannabis related properties, which is very hard to come by. But more and more banks are warming up to the idea and getting more comfortable with the legislation that's going on regarding cannabis related properties and cannabis related funds. So that's been very encouraging. Medical office is very hot right now. We're working on several medical office properties, healthcare type properties. Lenders love healthcare long term is not going anywhere. So healthcare is a very favorable asset type. Land is extremely difficult right now. Land's always kind of a tricky asset type to get debt on or to get equity placed on. But now, more so than ever for obvious reasons, lenders want to put their money out on assets that are cash flowing. They don't want to park money into land that, there's not any real, plan to develop yet. And construction costs, just to quickly touch on this, construction costs are so high right now that, it's hard to make deals pencil out. So there's a lot of uncertainty in the land side. Yeah, the last one I would want to touch on is we just got a really nice student housing deal done out in Boulder, Colorado. That student housing is a tricky, asset type. It's kind of like multifamily, but underwritten a little bit differently. You've got, year-to-year leases and parental guarantees. And student housing, traditionally has gone, a lot to Fannie Mae and Freddie Mac, and to the CMBS market. Those groups are a little, skittish of student housing right now. So, banks are picking up some of that business. Credit unions are picking up some of that business. But student housing definitely encouraging, but not quite all the way back yet.
Can we talk a little bit about the state of Florida as a whole? Are there areas that lenders are like, whoa, that's a little heated, that asset class and that market, we're not going to do that? Is there anything you're seeing out there right now that maybe lenders are showing some concern about in terms of the Florida market?
Yeah, there are, and it's more on a case-by-case basis. I wouldn't say overall, we're seeing any kind of pullback from one specific market. The first thing that comes to mind is there are, some lenders that just feel that, the South Florida, Miami, Fort Lauderdale area has just become a little too overheated, and, valuations are just not on par with where they think they should be. So there are some lenders out there, avoiding South Florida loan opportunities. And then tertiary markets are always kind of one that lenders struggle with.
Define for the listeners, but I'm not going to let you get past that without defining for them what you consider tertiary markets.
Yeah, so it's any market that's not your Miami, your Orlando, Tampa, Jacksonville. Typically
Winter Haven.
Yeah, so some lenders would consider that tertiary. Some would consider that to be kind of a secondary market. But okay. It's typically the national lenders consider, the top 50 or the top 100 MSAs to be, primary or secondary markets. And then anything kind of outside of those MSAs that fall outside of those MSAs would be considered tertiary.
Gotcha. So much of the panhandle then.
Yeah, a lot of the panhandle, like Ocala would be considered tertiary by most lender standards. Interesting,
as much as the growth, because really Ocala, the Villages is considered now a suburb of Ocala. So are they? How do they feel about the Villages compared to Ocala? Is there like a line there that say Villages yes, Ocala no?
Some lenders would look at that, it would include the Villages as part of Ocala. Others would say, it's not really part of Ocala. That would be a case-by-case basis. And, there might be some lenders that would include Ocala as, kind of part of there between Gainesville and Tampa, and it's got the Villages. So, there's enough kind of economic drivers there to consider it a secondary market instead of a tertiary market.
Gotcha.
That's a kind of a tricky question to answer because all lenders kind of have their own parameters as to what they designate markets.
So, Casey, if somebody's listening to this podcast and they see like Franklin Street's Capital Advisory, it's a pretty intimidating title. What kind of loans or financing can people come to you with? What's too small? What's too big? What's the range that you're going?
Yeah, so that's a very good question. So, Franklin Street Capital Advisory, we're strictly a third-party brokerage firm. We are not a direct lender, although we hope to change that sometime down the road. But, most of the business that we do is, call it $1 million to $20 million loans or equity checks. We're really property type agnostic. We'll work on everything any property type that I've spoken about today. We really don't have a preference. Right now, we're doing a lot of multifamily and industrial because that's what's most active. But we focus specifically on Tampa, then on Florida, then on the Southeast. But we really are doing loans all over the country. I mentioned we just did a student housing deal in Boulder, Colorado. We're working on transactions in Virginia, and New York, and Chicago, Mississippi, the Carolinas. So we're doing debt and equity placement all over the country. But obviously, we want to focus on our backyard, and that's Tampa and that's Florida. So we think that the value that we add is that we're not experts in any one property type. The value that we'll add to an investor, to a borrower, is that we take a very data-driven approach to what your needs are, and we go and we quickly and efficiently find access to the capital that you're looking for. And that's that's really the long and short of it for us.
So rather than working from an investor walking into a single institution and then it sits on their desk and you're either going to get a yay or a nay, you can look at cover multiple sources and just help them do things maybe.
Absolutely. Yeah, absolutely. So, each request is different. Each assignment is different. There are times where someone brings us an assignment and we know exactly who that one lender is who's going to, offer, the best terms without question. And it's a pretty easy quoting process. There are other times where it's a tougher request. It's a little bit more of a niche request, and you got to shop that request or that assignment to 15 to 20 different lenders, and we have the ability to do that and do that very quickly for you. So that's really the value that we add is the efficiency to get your loan request in front of a lot of eyeballs very quickly.
Awesome, Casey. Folks want to get in touch with you. Want to talk about a loan, talk about a deal. How do they go about doing that?
Yeah, so visit www.franklinstreet.com. I'm on the website. You can find my phone number, my direct phone number, my email. My email is casey.siggins@franklinst.com. And LinkedIn, I'm on all social media. Find a way to get a hold of me, and I'd be happy to have a conversation with you and provide any guidance that I can.
Awesome. Stephen, anything else before we let Casey go?
Casey, thank you. We've been through a tremendous economic upheaval, and hopefully things are getting back to normal, and we appreciate the update, and we'll be talking again in the future to get another update.
Absolutely. Stephen, Eric, thank you very much for having me on the show. I really appreciate it. I listen to this show pretty frequently, and I'm honored to be a guest on it. So thank you very much, and happy to come back whenever you'd like.
Casey, as always, we appreciate the time, the dedication that you show when you come here and prepared and ready to help our listeners learn about the debt market. So have a great 2024 and look forward to speaking to you in the future.
Thanks, guys.
And that was Casey Siggins from Franklin Street Capital Advisory. Stephen, always love talking to Casey. He's a very knowledgeable guy on the debt markets.
Yeah, and especially important now as we're coming out of what's been a very difficult period. We've still got a way to go, and what's going on and where to find financing, and he's a wealth of knowledge.
Yeah, Casey definitely is. He's also very efficient in how he provides information. I mean, we've sat through some of these debt conferences where we're there for 2 or 3 days at a time. Casey seems to be able to put it down in a 30-minute clip. So thank you, Casey, again. We always love having you on the show. Stephen, Casey was a great guest. Where can we get other great guests?
Casey today was a great example of just how important some of these podcasts can be and what we can learn from it. And you should go to the one place that's the most important place, and it's www.investfloridashow.com. Also, download the app on your mobile device and listen while you're commuting or in the gym.
Guys, as always, we appreciate the time that you invest with us each and every episode. Until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Stephen Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.